Welcome to How to Avoid Common ACA Reporting Mistakes. I'm Scott Hovis, your moderator. Throughout this session, please submit your questions using the questions field found in the right-hand side of the screen. All registrants will be provided with a recording of this webinar within 24 hours of the conclusion of this program. And with that, I'm going to hand the webinar over to Steptoe.
Thank you, Scott. Hi, my name is Lisa Czarlinga, and I'm the co-chair of Steptoe's tax group. I recently returned to Steptoe after spending almost 4 years at the Treasury Department, where I served as the Tax Legislative Counsel. In that role, I oversaw the preparation of regulations and other regulatory guidance and the preparation of the President's budget proposals for a range of domestic tax policy issues, including implementing the Affordable Care Act. At Steptoe, I advise clients on tax policy issues with respect to proposed tax legislation and administrative guidance. And I'm also doing the type of work I did at Steptoe prior to joining Treasury, which includes a mix of structuring corporate transactions and tax controversy matters. I am pleased to be joined by two of my colleagues, both of whom are well-versed in the Affordable Care Act. Joanie Andrea joined Steptoe a little over a year ago. She advises clients on a range of employee benefits and executive compensation matters, including plan design and compliance issues, welfare benefit plans, executive compensation, and mergers and acquisitions. Joanie has also been advising clients on compliance with the Affordable Care Act. Cameron Arterton is the newest member of Steptoe's tax group, having joined us in September from the Treasury Department. At Treasury, Cameron served as the Deputy Tax Legislative Counsel, overseeing the development of regulations and other administrative guidance on a variety of issues, but she spent a significant amount of her time on implementation of the Affordable Care Act. Prior to joining Treasury, Cameron worked on the Hill as Representative Lloyd Doggett's Ways and Means Counsel, focusing on tax, trade, and budget issues. Today we're going to discuss what we've identified as the top 10 filing mistakes. These include mistakes in compiling the data needed or in classifying the data collected, mistakes in filling out the required forms, as well as misunderstanding the filing requirements and the potential penalties for not timely filing correct returns. But before we get into the top 10 list, Joanie is going to give us a quick overview of the employer penalties under Section 4980H.
Thank you, Lisa. All right, so let's focus on why we have to do this reporting and what we're trying to avoid. The purpose of the reporting and the reason that the IRS is seeking this information is so that they can assess the employer penalties that will apply if the employer does not make a sufficient offer of coverage. The forms will identify the employer subject to the penalty for failing to offer minimum essential coverage to full-time employees. The form is also going to give information identifying employees who may qualify for a premium tax credit for coverage purchased on an exchange. And it's going to give the IRS information that identifies employees subject to the individual shared responsibility payment for failing to obtain coverage. Let's overview the employer penalty under Section 4980H. What triggers the penalty? First of all, in order to trigger the penalty, at least one full-time employee has to be certified as receiving a federal subsidy, a premium tax credit or cost-sharing reduction, when purchasing individual health insurance through an exchange. So if there's no subsidy, there's no penalty. Employer-sponsored health plans offered must provide minimum essential coverage, which we're going to be referring to during this presentation as MEC. And the MEC, minimum essential coverage, offered by the employer-sponsored health plan has to provide minimum value coverage and affordability to avoid the penalty. There are two types of penalties under Section 4980H that could apply to employers. They're referred to as the A and B penalties, and we'll use that terminology here. The A penalty will be assessed when a large employer fails to make an offer of minimum essential coverage in a group plan to substantially all full-time employees. Now, in 2015, substantially all is going to mean 70% of full-time employees. but in future years that number will be 95%. Then any full-time employee certified as having received a federal subsidy when purchasing individual coverage on an exchange. So offering to substantially all and having someone go to an exchange and get a subsidy will result in a $2,000 penalty per full-time employee. So this is a large penalty. There's a grace number of employees that can be excluded from this calculation, but in general, the penalty is $2,000 times the number of full-time employees. The B penalty is going to be equal to the lesser of $3,000 times the number of full-time employees certified as having received an applicable premium tax credit or cost-sharing reduction for coverage purchased on an exchange. This penalty applies to people who go to the exchange and receive a subsidy even if the coverage provided to other employees satisfies the requirements. So with that, let's go to our top 10 filing mistakes we're going to talk about today. Of course, we don't really know what the mistakes are going to be because this is the first year of filing, but we compiled this list based on things that people are asking us and other difficulties that we even ourselves have had in trying to figure out how to fill out the form. The first filing mistake, failing to coordinate information with vendors and within internal systems of the employer. 2 is failing to understand the filing process. 3 is failure to include employees who are not paid by the hour, so you might have trouble counting their hours. 4 is misreporting an offer of coverage that's actually made outside an open enrollment period. 5, miscounting 50 full-time equivalents. 6, the incorrect use of the codes that are used to fill in the forms. And 7, the incorrect cost of self-only coverage to be used on the form. Number 8 is incorrectly reporting non-employees in self-insured plans. 9 is the misuse of reporting safe harbors. And 10 is a total failure to file. So with that, we're going to go through these mistakes, and I'm going to hand it back to Cameron.
Actually, Lisa. Thank you, Joanie.
Oh, I'm going to hand it back to Lisa.
So the first error is failing to coordinate information with vendors and within internal systems. One of the things that makes ACA reporting so complicated is that it requires pulling together information that often resides in different systems that don't necessarily talk to one another. For example, it may be the tax function that files the forms, the 1094 and the 1095 with the IRS, and the employee statement to the employees. It might also be the tax function that files for extensions and requests relief from various penalties from the IRS. The insurance information regarding what each employee was offered and who in the employee's family is covered may reside with human resource function. And the addresses and social security number of the employee and the employee's W-2 wages may reside in the payroll function. And finally, the employer information and information about the applicable large employer members may reside in the general corporate function. And so you've got to pull all of this data from these various systems to put on one form to submit with the IRS. And if you're using a vendor, you have to be able to transmit that information to the vendor so that they can properly complete the forms. So this is one of the biggest difficulties with the ACA filing requirements, and is our number one, or our first failure, or our first filing mistake. Just so we should probably explain, these filing mistakes are in no particular order as to priority. We sort of put them in order of from pulling the data to filling out the form to post-filing types of mistakes. So they're more in order of time as opposed to priority. So Cameron, take it for number 2.
So number 2 is failing to understand the filing process. And this covers a variety of issues that you encounter as you're sort of sitting down. As Lisa said, you're kind of sitting down and trying to understand how to file these these returns with the IRS and with the participants. And to the IRS, the filing has to be electronic and paper to participants. There is a process for providing electronic statements to participants, but consent has to be obtained beforehand. This is similar to the existing process for furnishing electronic copies of W-2. Also be sure that the signature for filing these statements is on the 1094-C, which is the transmittal. It's under penalties of perjury, and there's no signature on the 1095 because you're signing on the transmittal, covering both. The filing deadlines are very important, and they're very different, as I'm sure many of you are familiar that the filing deadline for employees is February 1st. Usually it's the 31st of January, but that's a Sunday, so this year it's the 1st of February. And then for the IRS, it's March 31st if you're filing electronically. The next issue under a filing process is getting a filing extension, which is on the next slide. And it's if you cannot make the deadline that I just described, there are ways to get filing extensions. And for the form filed with the IRS, you can get an automatic 30-day extension, and you don't have to provide any kind of explanation. You just file the form 8809, and then you have an automatic 30 days. For the recipient statements, currently recipient statements are not eligible for this automatic extension, and so you have to request the extension by filing a letter and explaining why you need it. The IRS has recently indicated, however, that they're considering ways that they might make the request for the extension easier for the Form 1095, and so we'll see what they do to make it a little bit easier and hopefully make the processes a little more similar or in sync. And then finally, on the next slide, failing to understand the filing process, the final issue that we wanted to note here is to make sure that there is good communication with the participants in the process. So this is going to be very important to reduce employee confusion. It's important, obviously, so that employees know how to file properly, but one thing that's different with this than others is that it also really could impact the employer too as well, because if the employees misunderstand and incorrectly claim the premium tax credit, it's going to be a big headache to sort out whether 4980H penalties are triggered or not. So one great way to avoid that is to have good communication and be thinking ahead about how to provide this communication to your employees. And so I'm going to turn it back to Joanie now for number 3.
Okay, our number 3 is failing to include employees not paid by the hour. And when I say not paid by the hour, I'm talking about the larger problem of trying to determine who your full-time employees are so that you know, first, whether you have 50 full-time equivalents, and second, whether you have to provide the filing information for full-time employees. So you would have to count their hours to see who has an average of 30 hours a week per month to be subject to the reporting requirements and to the ACA. So I don't know how much of this is going to apply to your particular industry, but I'm going to throw out a few examples. For example, if you have an employee paid on a commission basis, for example, you might not know exactly how many hours that would translate to, because the person is paid based on number of sales that they make rather than hours. So the IRS has not been very specific on this issue. They've merely said that you have to use a reasonable method for sort of translating commission salespeople into figuring out what their hours are and whether they're full-time. So in using a reasonable method, it's not reasonable, for example, to take into account only a portion of the employee's hours of service so that it would recharacterize an otherwise full-time employee as a non-full-time employee. So one example of this would be if you had a traveling salesperson commissioned on a commission basis, not counting their travel time and making that person a part-time person when they should be counted as a full-time person. Another example of this might be the number being paid by the number of miles driven or being paid by the piece. Again, I'm not sure how this translates to your industry, but just keep in mind the inability to count hours or the failure to pay based on the hour won't get you out of having to determine full-time equivalents. I'm just going to mention number 4 very briefly. In trying to decide if an employer has made an offer of coverage, many employers have an open enrollment season so that people can't enroll during the year. However, once employees are eligible for the health plan, they are considered to have an offer of coverage for the 12 months, even if it's made outside the open enrollment period. Okay, so getting down to the nitty-gritty here, our number 5 top 10 filing mistake is miscounting 50 full-time equivalents for purposes of reporting. The 50 equivalent mark is important because it lets you know whether you have to file Form 1095-C and what information has to be on the form. So in counting 50 full-time equivalents, it's important to note that businesses that are commonly owned, that have common ownership and are, for purposes of the tax code, considered to be controlled groups, will be combined for purposes of counting the 50 employees. So for example, if you had a controlled group sort of parent company with subsidiaries with a sufficient ownership percentage to constitute a controlled group, and the parent had 20 full-time equivalent employees and each sub has 15, then each employer in that controlled group is treated as if they had 50 full-time equivalent employees, and each company in that controlled group would have to file separately on Form 1095-C, even though none of them individually have 50 full-time equivalents in and of themselves. So this is a little complicated. I imagine it would be complicated in your industry because you would have to know what the ownership of various stores is. So for example, you could have different stores that are owned by the same entity that constitute one employer, even though it's 2 separate locations, neither of which has 50 full-time equivalents on their own, but have 50 full-time equivalents when combined. So each one of those entities would have to file. Now, they don't each have to file. They could be filed on the same. They could be filed on the same 1095-C. But the transmittal of those 1095-Cs would have to include information showing that the entity is a controlled group, and that one of the, if there is more than one Form 1095-C filed, then one of the transmittal forms would have to be designated as the authoritative transmittal. Now, in counting the 50 employees, you only have to count full-time employees, so you would not, for example, be counting as full-time employees for determining the 50 sole proprietors, partners in a partnership, S corporation shareholders that own at least 2%, people who are classified as independent contractors, and other categories of people who are not employees. This makes it important to make sure that you have independent contractors who are properly classified as full-time employees. So in other words, if you misclassify an employee as an independent contractor and exclude them, then you might blow the determination of the 50 full-time equivalent employees. I'm going to move on to the form 1095C and the incorrect use of alphanumeric codes. Okay, here's where we get into the nitty-gritty of the form. Here's a picture of the form. This is page 1 of the form. You can see in part 1 of the form, at the top, there is employee information, including the employee social security number. On the right-hand side of the form, at the top, you can see the information that would be provided by the applicable large employer member. In other words, the employer that must file because either it has 50 full-time equivalents or is part of a group that has 50 full-time equivalents, along with the employer EIN for each employer in that group. Part 2 is the information that the IRS is going to collect to figure out whether an offer of coverage has been made to an employee for each month, whether that coverage is affordable by listing the employee paid portion of self-only coverage, and in line 16 there in part 2, whether the employer is going to be subject to the penalty, the A or B penalty that we just discussed under Code Section 4980H. So that's a lot of information in those 3 lines of this Form 1095C. In Part 3, you can see that covered individuals have to be listed with their Social Security number, or if the Social Security number is not available, using the date of birth. And there are rules that would require an employer to go out and seek Social Security numbers for covered dependents who are listed in these columns. This information denotes who is enrolled under the plan for each month of coverage. Now you can see the way we're going to convey all this complicated information to the IRS is through the use of these alphanumeric codes on line 14. So there are various codes that tell that are designed to provide information about the offer of coverage. So just looking at code 1B here, you can see that that's code for minimum essential coverage, providing minimum value, offered only to an employee. 1C is MEC, providing minimum value coverage, offered to an employee and to dependents, but not the spouse. D is the same coverage offered to the spouse, but not the dependents. So it goes on through all these codes, trying to describe the nature of the offer of coverage and whether it qualifies as an offer of coverage for purposes of the ACA. On line 16, we have the alphanumeric codes that are going to indicate whether the employer may be subject to a penalty. So that will tell you things like in 2A, whether the employee is employed during a particular month. 2B is whether the employee was not covered, for example, because they were full-time and did not enroll, even though the coverage was offered. 2C indicates somebody enrolled in coverage, and so on. All right, we're going to do a few examples using Form 1095C and these alphanumeric codes. And I hope that each of you will critically evaluate the use of the codes we've made here. There are different combinations that are possible for different circumstances, and you'll have to evaluate your own circumstances very carefully. These are kind of simplistic examples to try to just get the point across of how these forms are filled out. So for purposes of our examples, we're going to assume an employer with over 100 full-time employee equivalents that offers a self-insured plan that covers all full-time employees, spouses, and children, provides minimum value, and charges an employee contribution toward the monthly premium of $150 per month for self-only coverage. So the $150 is the employee portion of the premium. Let's look at John in example 1. John is a full-time employee with W-2 compensation of $25,000. John has worked for the company for many years, and in this particular year, he has worked all 12 months and been covered for all 12 months. For that reason, on line 14, we can use the all 12 months box, and we're going to put in there code 1E to indicate that our coverage is coverage providing minimum value offered to an employee, dependents, and spouse. So we use 1E for line 14. In our assumptions for line 15, we assume that the employee share of the lowest cost monthly premium for self-only coverage is $150, and John is enrolled, so we indicate on line 16, 2C, employee enrolled in coverage. So this is a simple example for John. Let's look a little more closely at John. Why can't we use 1A? You know, if this is a good offer of coverage and it's minimum value and affordable, why can't we just use 1A? The reason is that 1A is available only if the MEC providing minimum value to full-time employees has an employee contribution for self-only coverage equal or less than 9.5% of the federal poverty line for individuals. Because 9.5% of the single federal poverty line for 2014 is the poverty line for singles in 2014 is $11,670, and that works out to a premium of $92 a month. So if you're able to show self-only coverage for $92 a month, then you can use 1A. We can't use 1A here because our coverage is too expensive. It's $150. If we try to figure out what 9.5% of $25,000 is, that's John's W-2 coverage, John's W-2 compensation, it would work out to about $197 a month for the self-only premium limit. And since $150 is less than $197, we're okay under the W-2 safe harbor on line 16. So on line 16, we could have put 2F there, indicating that our coverage is affordable because of the W-2 safe harbor, but the instructions tell us that under these circumstances, we should always try to show whether or not the employee is enrolled in coverage. So we use, in that circumstance, 2C instead of 2F. Going to part 3 of Form 1095-C, our plan is self-insured under our assumptions, so we check the box up the top showing that we are self-insured. We list our covered individuals, John, John's wife, John's child. They were all covered for all 12 months. And we have all their Social Security numbers, so we were able to put those in there. We didn't have to use birthdays. Okay, let's look at example 2, Jane. Jane is full-time eligible, but she has not previously enrolled. But Jane had a baby, and she special enrolled herself and the baby under the HIPAA rules around September 15th, so mid-month September. We know that in line 14, we can use 1E because our coverage is MEC providing minimum value to employees and dependents and spouse. We know our self-only coverage premium for employees portion is $150. But let's look at line 16. We know in January that even though Jane was eligible for coverage, she did not enroll. So we're going to put here, we're not going to put 2C because she's not enrolled like John was. We're going to use 2F, showing that she satisfies the safe harbor for W-2 compensation. And we're going to assume here that she makes at least $25,000 like John. So she's not covered for most of the year, and we go through it month by month, showing although she got the offer for 12 months and it's affordable, she did not enroll until we get to September. Now, she enrolled herself and her baby in September, but since it was mid-September, she wasn't enrolled every day of the month. So we can't use 2C here. We use 2F, and that's indicated by the green 2F there. She wasn't covered every day, so we can't use 2C, but starting in October, they're covered, so we use 2C, she's enrolled in coverage. Okay, so we're self-insured. Here's part 3 for Jane. We have Jane, we have Jane's baby, but we don't have a Social Security number for Jane's baby, so we're going to use the date of birth. Now, there's no coverage, as we already saw, until September, but here on this part 3, we're going to check September as having been covered, because for purposes of this part 3, if you're enrolled for only one day of the month, then you check the box for being enrolled for that month. So we check September as the month that they're enrolled, and October, November, and December. Example 3 is Kathy. Kathy is a new full-time employee, and let's say she was hired February 1st. We're not going to say mid-month February because we're just going to make it easy on ourselves, February 1st. But she has a 9-day waiting period under the eligibility terms of the plan. She can't get in for 90 days. But she transferred to part-time in September. So what is Kathy's Form 1095 going to look like? All right, we're going to assume for purposes of this example that the employer measures full-time status based on the monthly measurement period. So it's going to determine full-time status every month instead of using a look-back year. Okay, so for the first 4 months of the year, we're not going to use 1E here, we're going to use 1H, no offer of coverage. So for January, you can see she got no offer of coverage because we see in line 16, she was not employed during that month, so we use 2A there. February, there was no offer of coverage because now she starts her 90-day waiting period, and that's indicated on line 16 by using code 2D, the employees in a section 4980HB limited non-assessment period. And that's a code that's used not only for the 90-day waiting period, but as we'll see, for purposes of a look-back year calculation. So for February, March, and April, she's 2D. Starting in May, though, she's offered coverage because she completes her 90-day period. So we use 1E in line 14. We show the $150, and in line 16, we're going to show that she is enrolled in coverage. So she's enrolled for June, she's enrolled for July, she's enrolled, switches to part-time. When she switches to part-time, just looking at line 16B there, we show her as not a full-time employee and did not enroll for the month covered. But in line 14, we're still using 1E, that she got an offer of coverage under our great plan because she's eligible for COBRA. Now in this example, we did not have her elect COBRA. Of course, she's eligible for COBRA because she had a reduction in hours that caused her to lose coverage. So we're going to offer her COBRA. And the question is, do we show the self-only premium for COBRA coverage? Well, it depends on when her coverage ends because of her part-time status. Maybe it goes to the end of the month, or maybe it ends mid-month, right on her termination, right on her date that she reduces hours. So we don't know whether to put the COBRA premium here. It sort of depends on the facts. For October, we show she's eligible. She gets an offer because she's still eligible for COBRA. We show the COBRA self-only premium, and we're still showing she's not full-time. She did not enroll. And when her COBRA premium, her COBRA enrollment period ends at the end of November, then for December we go to 1H, no offer of coverage because 2B.
Hey, Joanie, I'm going to have to stop you right there. We've had a report that there's an issue with sound.
On part 3 for Kathy, we're going to show that she actually was enrolled in coverage for May, June, July, August, and September. And again, because if she was enrolled for only one day of the month, then we check a box here.
Hey, Joanie, can you hear me?
Okay, so let's talk about line 15. We're counting this as mistake number 7. So we're already at number 7, and that is incorrect cost of coverage for purposes of line 15. In example 4, Simon is a full-time employee who, instead of electing a taxable opt-out bonus of $100 a month, instead elects coverage. Now, maybe some of you have heard of employers who offer a bonus to employees who don't enroll in coverage. How is this shown on the form? Well, he gets the great offer of coverage for all 12 months, so we have 1E on line 14, and he enrolls in coverage, so we're going to show 2C on line 16. But what do we have for line 16 here? Yes.
All right, we've had a report that some people are having issues with audio.
Okay.
All right, so what I'm going to ask you to do is, audience, if you are having issues with audio, if you could type that into the question and answer section or the chat and just let me know. And both of those things are fine. I'm just giving people an opportunity to kind of let us know how bad of an issue it is.
Shall I continue, Scott?
All right, I have a report now that they can hear. So if you are having issues, to the audience, just dial back into the number, and you should be able to hear that way. Yep, Joanie, please proceed.
Okay, thank you, Scott. Well, for those of us with short attention spans, including myself, I'm going to just run back over this for a minute. Simon took an opt-out bonus, Simon was offered an opt-out bonus for not electing coverage, but he refused that, and in fact he elected coverage. So he's 1E on line 14 for having gotten our offer of coverage. He's 2C on line 16 because he did in fact enroll in coverage. But on line 15, we see that the cost of the taxable opt-out bonus is added to the cost that he would pay for self-only coverage. So instead of our $150, we have to add the opt-out bonus to that because it cost him $250 because he had to forego that bonus in order to get coverage. Now, what if Simon, like John, had W-2 comp of $25,000? Well, from the analysis that we did before, 9.5% of the W-2 safe harbor comp of $25,000 would work out to a premium of no more than $197 a month, and here, because we're at $250, we've gone over. I'm going to move ahead now to our last example, Felix. This one is just a color-coded mess here, so I'm going to try to go over it carefully. Felix is a full-time employee who went part-time in May. He enrolled in COBRA, and then he got married in October, and he elected his husband's coverage. So again, we're going to assume the monthly measurement method for counting full-time employees. He got an offer of coverage for line 14 purposes January, February, all the way through August. He had coverage for January, February, and March, but when he went part-time, he lost his coverage. And again, it depends on, did he lose it mid-month? Did his coverage continue to the end of the month? But he lost his coverage, and he then became eligible for COBRA. And let's say, in fact, here he did elect COBRA. So we have him at 1E starting in May, getting an offer of our great coverage. We're going to show the self-only premium for COBRA here that the employee has to pay. And we're going to show him covered through September. And again, we don't know what happened. We don't know exactly when in September. He's still covered by COBRA throughout September. Okay, but in October he got married. So, and he elected his husband's coverage. So For line 14, we're going to show him 1H, no offer of coverage, because he's part-time, and that's indicated by our, I guess we could use the part-time 2B, but here we're going to use 2F. He did not get an offer of coverage, and we used 2F here. As I said, others may differ, but as Cameron will explain to you later, we have good faith reliance, good faith effort in 2015. So if you made a good faith effort and got the wrong code, you should still be okay, as Cameron will explain. Okay, putting that behind us, we're going to move on to mistake 8, which is incorrectly reporting non-employees in self-insured plans. Okay, so some plans cover non-employees. So examples of this would be directors, non-employees on COBRA, and retirees. And the question is, do we have to report them? Because we just made a big deal out of having to report people who are full-time employees and full-time equivalents. Do we have to report non-employees? And there may be other categories here. For example, the people I listed that you don't have to count for purposes of determining your 50 employees, like sole proprietors, partners, etc., may actually have to be reported for purposes of determining whether those individuals are going to be subject to a penalty. So by way of explanation, we've already gone over the forms. Now, where the non-employees would have to be reported is in our Part 3 in a self-insured plan. So let's go back to a Part 3. Okay, so you can see here, they're covered individuals. We would list them, and we would list the dates that they're covered. So for a self-insured plan, you could, if you wanted to, report the non-employees in Part 3 of Form 1095-C, which for a self-insured employer may be the only types of form that they're going to be confronted with. But in fact, if an employer wanted to report the employees on a Form 1095-B, which is the form typically used by coverage providers, that would also be permissible. So for example, in an insured plan, if your plan is insured rather than self-insured, your insurance company is going to fill out the Form 1095-B showing who's enrolled. But if you're not insured and no insurance company is filling out the enrollment information on Form 1095-B, the employer itself can file a Form 1095-B or, at its option, include that enrollment information on Part 3 of Form 1095-C. Now this is very confusing because the treatment of these non-employees is, in my opinion, not very well addressed in the instructions to Form 1095-C. But this is our interpretation of what happens if you have partners, directors, non-employees who are enrolled in a self-insured plan. Okay. This mistake number 9 is listed as misuse of the reporting safe harbors. Now, I don't know how many of you are attempting to use the reporting safe harbors for purposes of satisfying the requirements of the ACA reporting, because the forms are complicated enough without having to actually try to figure out the safe harbors. But if you were using them, you might have to, you may be relieved of the amount of information that you report in a few instances. And so that's why some people may elect to use the reporting safe harbors. What's on the screen right now is a picture of Form 1094-C. We just looked at 1095-C. This is 1094-C. This is the form that you're going to use to transmit the 1095-Cs to the IRS. So there it is, transmittal of employer-provided health insurance offer and coverage information returns. If you want to use a safe harbor, You go down to line 22, and on line 22, this is where the employer would certify its eligibility to use one of the safe harbors. And there are 4 of them there. A is the qualifying offer method. B is the qualifying offer method transition relief. C is the section 4980H transition relief, and D is the 98% offer method. You can also see on this form, this is where you list whether you're part of an aggregated ALE group, whether you're part of, this is where you indicate whether you are filing a separate employer return, but you've aggregated with other employers for purposes of counting employees. And that's on line 18 and 19. You can see it refers to, you've got to say whether it's an authoritative transmittal in case you have filled out information for an employee on a collective basis rather than just on a per employer basis. I know this is a little complicated, but this is explained in the instructions. The point here on this is to make sure that you have the right employer group for purposes of counting your 50 and filing the forms. So let's try to go through the reporting safe harbors. The first safe harbor is the qualifying offer method. That was item A on line 22 that we just looked at. This is where you can use 1A. This is a situation where you're able to check the box that the employer made a qualifying offer to an individual employee in each of all of the 12 months for the year. That is, the employee got an offer of at least minimum value coverage. Contribution for employee-only coverage was no more than 9.5% of the federal poverty level, and it was offered to the employee's spouses and dependents. If you can use the safe harbor, then you don't have to worry about all the codes for lines 14, 15, and 16. You can use 1A. But this is only for your employees who actually got a qualifying offer, that is 1A for all 12 months. If it was less than 12 months, you can't use this simplified method. But if you are able to use this simplified method, then you don't actually have to give the Form 1095-C to the employees. Instead, you can just give them a simplified narrative statement that gives the employer's name, address, and EIN, the contact name for information on where to get information on an offer of coverage, a notice of whether the employee is eligible for a subsidy, and a reference to IRS publication 974, which attempts to explain all this. But you don't have to give the employee the 1095-C. So if you're worried about having made mistakes on that form, then at least they're not counted for penalty purposes if you can use this simplified reporting to the employees. But because of the restrictions of using the code 1A for a qualifying offer, this is going to be pretty limited. There is a transition rule just for 2015. So in 2015, if you made a qualifying offer to at least 95% of your full-time employees, then regardless of whether they worked all 12 months or not, you can still use the simplified method, and you can use 1A. That's only for 2015. You can leave line 15 blank. So for what that's worth, those are the first 2 safe harbors, qualifying offer method and the 2015 transition rule. Okay, this is the reporting safe harbor for 4980H relief. This is our item C on that line 22 we looked at on the transmittal form. Many of you may be familiar with the section 4980H relief because this is the relief that absolves employers with more than 50 full-time equivalent employees but less than 100 for 2015. Now, even if you get out of the penalty because of this transition relief, you still have to file, you still have to report. So you still have to worry about filing Form 1095-C. But checking the box for this transition relief will let the service know and will be explanatory for some of the other codes that you use. So if you have this, if you use this transition relief, check the box, and there's also relief. This can be used for other types of relief, such as for non-calendar year plans and some instances for multi-employer plan. You use those codes. But as explained here, you still have to fill out line 14 and 15. The last reporting safe harbor I'm going to mention is the 98% method, and that is a method that would allow you to not have to differentiate between full-time and part-time employees for purposes of the form. So if you were able to use all these safe harbor methods together, you could use a simplified code for line 14. You could leave line 15 blank. You could skip having to specifically identify your part-time employees on line 16. And then you could skip column B on page 2 of the transmittal form, where you have to list all full-time employees, and you can satisfy that by just giving the total employee count in column C. So it might save you some reporting of information, but maybe it's more complicated, more trouble than it's worth. So with that, I'm going to turn it back to Lisa.
Thank you. So this is actually Cameron with the last of the top 10 filing mistakes, and that is failing to file. And it's actually failing to file or failing to file a correct return. There are substantial penalties that will apply for either not filing at all or filing something that's not correct. And as we'll go through, there is relief that may be available to avoid or mitigate penalties, but you really have to be proactive and be thinking about these things even now. So the first issue is, I just want to go through the penalties. There's actually 2 penalties basically per return. So the return you file with the IRS is a separate penalty from for not filing that return versus the information statement that you send to the employees is an entirely different penalty. So one per employee, you could end up with 2 penalties for the 2 different kinds of returns, and they're each $250 per failure and up to $1 million per calendar year. And as we'll go through on the next chart, penalties can be reduced if the entity corrects or files within 30 days or before August 1st. So, and you can see on this chart the 2 different penalties that apply per return. The maximum is going to be $500 with a cap of an annual maximum penalty of $3 million, and if you correct within 30 days, that goes down to $500,000, and if you can correct not 30 days but before August 1st, it'll be $1.5 million. There's a de minimis errors. There's no penalty for de minimis errors, and also inconsequential errors are not considered a failure to file correct information. And an example there might be if you misspell the word street in the employee's address, but it's not significant and doesn't impede the ability to identify who the person is. That would be not considered that would be considered an inconsequential error. And there's some smaller limitations. If your gross receipts are under $5 million, there's a lower cap.
So, Cameron, what if you misspell the employee's last name instead of the street?
So something like that that actually involves the significant information, that is who the person is or the amounts or things like that, would be not considered inconsequential. That would be a consequential error that is you would have that is something that is not followed does not fall under this inconsequential error rule at all. So that is definitely something that you'd want to correct. I'd like to go through a couple examples here just to see how the penalties and the caps apply. The company A has 1,000 employees, so company A would qualify as an applicable large employer, so it has to file a 1094-C and a 1095-C. However, company A does not file these forms or send the corresponding information statements to its employees. So company A is facing a potential penalty of over $500,000. You can see how the math for that, how that breaks down and adds up to just over $500,000. The next example is looking at how the caps work. Company B has 20,000 employees and also does not file forms 1094-C or 1095-C or send the statements to the employees. So company B's potential penalty would be over $6 million. If you look at the actual math, it's actually more than that, but the cap comes in and limits it to $3 million per type of return, per IRS filing and per information statement to the employees. So next I want to talk about what options would exist to avoid or mitigate penalties. And the kind of main message here is that these are things you can start thinking about now. And if you anticipate that you're not going to be able to file on time, but you know you're not going to file perfectly correctly, there are some things you can do to start thinking about now to mitigate or even avoid the penalties. The first is get an extension, which is we discussed above, automatic 30-day for the IRS forms with the IRS, and you can request an extension for the employee statements. The second is the relief from penalties for good faith efforts to comply, which Joanie mentioned earlier, and I'll talk about it in a little more detail in just a second. And then there's also the general statutory relief from penalties. If for some reason the good faith, you don't think you can qualify for the good faith efforts 2015 relief, you may be eligible for general statutory relief from penalties for reasonable cause, which Lisa will describe. And then finally, there may be things you can do to minimize penalties. And so the first one is relief from penalties for good faith efforts to comply. And this is a limited penalty relief that the IRS has indicated just for 2015. The IRS will not impose penalties on employers or insurers making good faith efforts to comply. And the key here is that the employers who file incorrect or incomplete information returns but have made good faith efforts will not be subject to penalties. And critically here, if we turn the slide to 36, that you must file. The scope of relief is limited to good faith efforts to comply if you have timely filed an information return or furnished a statement. So that means both the information returns with the IRS and the information statements with the employees. And you have to be able to show a good faith effort to comply. So what constitutes good faith efforts? The official guidance is limited in the preambles to the reporting regulations. The IRS has specifically mentioned errors related to Social Security numbers or taxpayer identification numbers and date of birth. And an example that they've provided is that an insurer that makes a reasonable effort to obtain the employer identification number of an employer sponsoring coverage will not be subject to penalties for a missing or incorrect EIN. So they tried to get the information, they couldn't get it, they're not going to be subject to penalties for not providing that information. And I want to just take a second here to talk about TIN solicitation, because this is one of the pieces of information that we hear a lot of questions about what if you can't get the TINs from people, the socials. There are general rules about TIN solicitations, and the IRS has sort of put out specific rules about solicitations of TINs for ACA reporting about exactly when you need to make these solicitations. And the initial solicitation has to be made at the first enrollment, or if you're already enrolled on September 17th, 2015, by during the next enrollment season. The second solicitation is made a reasonable time thereafter, and then the third solicitation is made by the end of the year following the initial solicitation. So basically, if you ask those 3 times, then you don't have to ask again for that particular TIN. Now, in past relief, can you switch the slide to 39, please? There has been in other instances of good faith efforts, penalty relief in the first year of reporting. It would be generally it's a facts and circumstance test for reporting errors, missing or obviously incorrect HINs, and incorrect HIN name combinations have been covered. But what has not been eligible, and the IRS has been clear that that applies here, is if failure to timely file a return. If you don't file or you don't file on time, then you're just not going to be eligible for the good faith efforts. So that's kind of, I think, the bottom line is do your best, try, but be sure to file something so that you can get in this good faith efforts penalty relief. Now, if you can't, for some reason you don't think you'll be able to qualify for this, there may still be a general statutory relief from penalties that might apply, and I'm going to turn it over to Lisa to discuss that penalty relief under the general statutory requirements.
Thank you, Cameron. Section 6724 provides for a waiver of information reporting penalties if the failure to file correct returns or to furnish correct statements was due to a reasonable cause and not to willful neglect. This waiver applies to all information returns, including the Forms 1099 series, the DIV, the INT, as well as the ACA forms. The reasonable cause waiver rules still apply for 2015, even though you have the good faith exception. As Cameron mentioned, if the good faith exception doesn't apply for some reason, you can still use this exception for 2015. And in fact, these rules actually may be instructive in how to establish good faith efforts. However, we believe that the IRS will generally be more lenient with respect to good faith than they typically are with respect to reasonable cause. So the reasonable cause exception is more likely to be of use beyond 2015. Reasonable cause generally exists if the filer can demonstrate two requirements. The first one is that there are either significant mitigating factors or the failure was due outside the filer's control. And the second one is that the filer acted in a responsible manner before and after the failure occurred. The existence of mitigating factors is a facts and circumstances determination, but the regulations provide a couple of examples. The first one is that the filer was not previously required to file the particular type of information return. And the second one is that the filer has an established history of complying with the reporting requirements in issue. Since 2015 is the first year of mandatory ACA reporting for all filers, these mitigating factors are not likely to be determinative. But for future years, as you start establishing a history of filing, they will become more relevant. Similarly, whether the non-compliance is due to events beyond the filer's control is a facts and circumstances determination. Here, the regulations also provide some examples. First one is unavailability of business records. For this exception to apply, there must be a supervening event, such as a fire or other casualty that destroys the records, or the unavoidable absence of the person who has the responsibility for filing. For example, they die or are subject to a serious illness. This exception usually only applies if it occurs within a short period around the filing deadline, generally like a 1 to 2 week period right before the filing deadline. The second example is undue economic hardship for filing on magnetic media. Magnetic media filing is not available for the Forms 1094 and 1095, so that is not going to apply here. The third one is the actions of the IRS resulting in reliance. This only applies if the IRS provided erroneous written information to the filer after it was provided all the relevant facts. This would come into play, for example, if the taxpayer received a private letter ruling or a determination letter, advice basically from the IRS that is taxpayer specific. Since the IRS has not been providing any taxpayer-specific advice on the ACA reporting requirements, they've only done general guidance up until this point, this example probably will not come into play. The next example is actions of an agent. The filer generally has to show here that it used reasonable business judgment in contracting with the agent for the preparation of the forms and statements and provided the agent with all the relevant information. The filer also has to establish that the agent has had reasonable cause for the failure. So this basically means that you have to reasonably rely on the agent. The agent then has to meet all these requirements we've been talking about to show reasonable cause. This factor might be helpful where the noncompliance is due to a vendor's failure to complete the forms in time, and the vendor had, for example, a casualty event or something that prevented it from filing on time. The next example is actions of the payee. This exception would apply if the employee or the insured did not provide the correct information to the employer. The filer must show that it made reasonable efforts to obtain the necessary information from the employee or the insured. Cameron already mentioned that specific rules are provided for TIN solicitation, but there could be additional information if the payee incorrectly provides as well. It's important to keep in mind that the regulations are more than 2 decades old for reasonable cause, and they don't necessarily contemplate the complexities of modern information technology systems. And as I mentioned before, the ACA reporting presents various complexities, pulling information from various systems that don't normally talk to each other. So the IRS manual actually provides a little bit of updated information with respect to electronic media events that are beyond the filer's control. And they provide a couple additional examples, including a major hardware or software problem, or the taxpayer contacted 2 or more service providers, but they wouldn't contract to prepare the information returns without requiring that the taxpayer contract with them to do a range of other data processing functions. So basically they were trying to hold them captive, say, we'll only do these forms if you contract with us for all this other work. And the last example given in the IRS manual is if the taxpayer is geographically remote and couldn't arrange for electronic media processing. The IRS manual also notes that reasonable cause may apply if the filer contacted a tax advisor that was competent on a specific tax matter. They furnished all the relevant information, and when it was then incorrectly advised that the filing of the return was not required. So reliance on an advisor is also shows reasonable cause. Once the filer demonstrates either mitigating factors or events beyond the filer's control, the filer has to show that it acted in a responsible manner. That is, that it exercised a standard of care that a reasonably prudent person would use in the course of business to determine its filing obligations. And it has to show that it acted responsibly both before and after the failure. The filer also has to take significant steps to avoid or mitigate the failure, such as requesting appropriate extensions, like Cameron mentioned, attempting to prevent a foreseeable failure, acting to remove the cause of the failure once it occurred, and rectifying the failure as promptly as possible. A correction is ordinarily considered prompt if it's made within 30 days of discovering the failure or of removing its cause. The IRS manual includes additional facts that the IRS will consider to determine if the taxpayer acted in a responsible manner. For example, does the length of time between the event and the filing date negate the event's effect? In other words, did you wait too long? Does the continued operation of the business after the event negate the event's effect? Was the penalty the result of carelessness or an honest mistake? And if a third person is being blamed for the failure, what is the nature of that relationship with the third person? Is it more of an agent like an employee? Is it an advisor like a lawyer or accountant? Different facts may affect the result differently. Does the filer have a history of the same penalty? Generally, if there is a history of the same penalty, the IRS might consider intentional disregard penalty if they start seeing patterns of failures. And could the filer have requested an extension or filed an amended return? So what if you don't file on time, so the good faith relief isn't available, and you can't establish reasonable cause? In that case, the best that you can do is to try to minimize your penalties. First and foremost, try to buy time. If you think that by filing an extension, for 30 days, you can compile the correct information and try to file the form correctly, do so. You might also reduce your penalty by filing as soon as possible. As Cameron previously mentioned, the penalty is reduced to $50 per return if the correction is made within 30 days, and $100 per return if it's made after 30 days but still before August 1st. So let's look back at an example that Cameron talked about a little earlier. Company A can't file on time. And as discussed above, Company A could be facing penalties of over $500,000. But if Company A believes that it can be ready within 30 days of the filing due date, then Company A should obtain an automatic extension for the filings with the IRS, and then when it does file and send the information returns, its penalty would be reduced. And the total penalty in that case would only be $100,000. There wouldn't be any penalty for the information returns filed with the IRS because you got an extension, and you'd have the reduced penalty for sending the information statements out before August 1st. It's important to consider the consequences of not filing the IRS form or the employee statement on time. For example, if the IRS doesn't receive the form before the employee files his return claiming that he had insurance coverage, the IRS system may spit out a letter to the employee indicating that they may be subject to the individual responsibility provision. And many employers that we've talked to want to avoid having their employees be contacted by the IRS. So it is something to think about in determining the timing of your filing. On the other hand, if you file the return with the IRS but the employee doesn't receive a statement on time, he might have trouble filing his tax return. So even if you can't get the employee statements out on time, you may want to try to consider ways to communicate the information with the employees through email and online posting or something like that to get them the information that they need to correctly file their returns. As we've mentioned, the determination of whether the filer acted in good faith or with reasonable cause are factual determinations, and the burden of demonstrating them are on the filer. So you should make sure that you document your efforts to comply with the reporting requirements as much as possible. And in summary, the new reporting requirements are quite complicated, as Joanie demonstrated through the series of examples that she went through, and those were pretty simple examples. But relief from the errors is available, particularly for 2015. But you need to file on time or request an extension if you need to. And you have to do your best to provide the correct information. Good faith efforts are likely to be fairly lenient in 2015. I think the IRS is going to give taxpayers the benefit of the doubt. And if that standard isn't met, you can still satisfy the general reasonable cause penalty relief. But the factors that must be established for reasonable cause are likely to be more difficult than the good faith effort. So with that, I think we will open it up for questions. And I think we've gotten a couple of questions in the interim. Joanie, have you?
Yes, I got a couple questions, and to answer them, Lisa, I'm going to ask that we go back to example, let's see, slide 19. Okay, so the question was, could I explain the safe harbors a little more? And I'm assuming for purposes of this question that they didn't mean the intensely complicated of questionable value safe harbors that I went over at the end there. And I assume they're talking about the safe harbors for counting compensation here to determine whether the coverage is affordable. So we're going to go back to Jane. We're going to look at Jane here. She got an offer of coverage for all 12 months at $150 for self-only coverage. She didn't take it. So in line 16, we put 2F. Okay, 2F is the safe harbor for a Form W-2 coverage. There are 3 safe harbors. Okay, the question is, why do you have to use a safe harbor? You know, why can't you just put the 1A number? You know, if you were to make a qualifying offer, why can't you just use 1A? Well, you would have to know 9.5% of the household income in order to use 1A. we don't know what the household income is for most people. There could be 2 working spouses. You know, we're just not going to know what their income is. So to solve that problem, the IRS created these safe harbors that we could use to determine affordability. The first safe harbor is that you can use the employee's W-2 comp without regard to what their spouse may earn or any other income in the household. You can just use the W-2 comp that you know. The second safe harbor is that you can use 9.5% of the federal poverty line for an individual. And the third safe harbor is that you can use, if you can't use W-2 comp or 9.5% of the individual federal poverty line number, you can use what's called the rate of pay. And rate of pay might happen, excuse me, you might use rate of pay, for example, in a union situation where you only know what the employees earn by the hour, or in any situation where the employer is not necessarily doing the W-2, may not have W-2 comp available, but knows how much the people make an hour. So it's permissible to use the rate of pay for the employee covered to develop the compensation amount for the safe harbor. I hope that's clear. Okay, so I got another question, and for that question I'm going to ask that we go to slide 21. Okay, so I hope this is not too confusing for people, but I want to use this slide as an example. I have 2 things to say about this slide. The first is a question we got from the audience. What happens if the person is offered COBRA because they terminated employment? This example just shows what happens if the person has a reduction in hours and they're offered COBRA. But what happens if you terminate employment and are offered COBRA? And that's a good question because, in fact, the treatment is very different. If the employee terminated employment, let's say before the end of the month, so mid-month, and let's say that coverage expires right on the termination of employment date. So let's say instead of continuing to the end of that month of termination, the coverage terminates on the date of termination. Okay, so for the 1095-C Part 2 Line 14 code, that's the 1 code, instead of 1E, we would show 1H. And 1H is no offer of coverage because we're showing that person is terminated, and even though they have an offer of coverage, the IRS has said if they're terminated, we don't use 1E, we use 1H. If they're terminated under the circumstances I described, and we use code 1H, then we just leave line 15 blank. We don't put the COBRA self-only coverage amount, we don't put our $150, we just don't put anything there. For line 16, we would put code 2B for the month of termination because in our example, the coverage terminates on the date of employment, so it doesn't last all month. So we can't say that the person is enrolled or covered for that month because in order to do that, they'd have to be covered every day of that month. And since we're cutting off their coverage mid-month, we can't use 2C there. We would use 2B. Okay, so what about the rest of the year? Well, for termination, we would use 1H for the rest of the year, and we would use 2A down in line 16. 2A, employee, non-employed during the month. So I hope that's clear. Trying to think. Oh, the other thing I wanted to say about this slide is I made a big deal on this slide about saying that the employer used the monthly measurement method to determine full-time employees for purposes of 1095-C reporting. Now let's say for Kathy, in our example here, let's say that Kathy was a new employee, but we weren't sure whether she was actually going to work full-time all year. We hired her. Maybe she's a variable hour, or maybe she's seasonal, or for some reason we're not sure whether Kathy is going to work for a full year. So when Kathy was hired, we decided we would use the look-back method for Kathy. And let's say our look-back period was the 12 months before this year that we're reporting here. So she worked for 12 months. She wasn't covered. We were trying to see if she'd work out to be full-time. And let's say she did work out to be full-time. So now this reporting year, this would be her stability period. For those of you who understand the secret language of Form 1095-C, this would be her stability period. And because this would be her stability period, even when she transferred to part-time in September, we would not be able to cut off her coverage because she would have to remain covered for her entire stability period. And a question that we got, not during this seminar, but the webinar we gave earlier this week, is involved a question of for counting 50 employees, 50 full-time equivalents. And the question was, well, we've had some layoffs this year. Business wasn't so great last year, and this year we don't have 50 full-time equivalents. Do we have to? Are we considered to be an ALE? Well, the 50 determination is made based on the average of the business days in the prior year. So if they had 50 full-time equivalents in the prior year, then they are considered to have 50 for reporting purposes for this year. And just for 2014, the service is letting the employers use a 6-month period, any 6-month period during 2014 to figure out that average. I'm thinking those are the questions that pertain to me. Oh, I see there's a new one here.
There's a couple new ones. I can take we received a question about is affordable coverage defined for each individual employee based on their rate of pay or W-2 wages and not based on the company as a whole. For example, the coverage has to be affordable for the lowest paid employee in order for the company to assume the plan itself is affordable. And I think the general response to that is that affordability is determined based on what the lowest cost plan available to that employee is. So it's an employee by employee determination. But if the company, for example, offers only one plan or the lowest cost plan to all of its employees, it would be a general determination. Does anyone have anything to add to that?
That's right. This is Cameron. It's the plan to which the employee could enroll, that is coverage that's offered. So a plan that the company offers but does not offer to that employee would not count. It's an individualized determination.
I thought there might have been a couple others, Joanie, that were in your section.
What are they? Wait, let me see.
Hold on.
Joanie, there was one question, do you furnish 1095-Cs to part-time employees?
Oh, I'm sorry, I read that as 1099s. Okay, so the question, do you furnish 1095-Cs to part-time employees? If the employees work less than an average of 30 hours a week per month and they're not covered, then no, you don't have to report them. And I should say, and you don't expect them, and you're positive that they're not going to be full-time. So it's not a variable hour or seasonal situation.
But if they're actually covered, Joanie, wouldn't you still have to fill out Part 3 for them?
If they're actually covered, yes. but I'm assuming, well, maybe I shouldn't assume for the question, but I'm assuming that part-time people are not covered, would not be covered in the example.
So did we catch all the questions? Are there any other questions that we missed?
Maybe everyone is just stunned.
And if you have additional questions that come up afterwards, you know, feel free. We've got our email addresses on the last slide, so feel free to reach out to any of us after the webinar. Oh, wait, here might be another question. Joanie, I think this one might be in your bailiwick. It's what if the employee during the stability period asks to waive coverage due to the cost of the benefit? Per the ACA, what is the correct procedure? Allow them to drop or follow your Section 125?
Now, I would think they'd be dropping in an open enrollment period. But, you know, whoever asked that question, please give me a call just so I understand all the questions. Well, just looking through my emails here to see. We have a majority of variable hours employees.
Joanie, there is a question. Do we need to file for any part-timers? I think we may have covered that.
I think we covered that.
Anything else?
Yeah, I think we covered that.
Okay.
Can you verify the entire Q&A is recorded? I think it is, isn't it, Scott?
Yep, the entire session is recorded and it will be made available later today.
Well, good luck, everyone.
All right, so with that, I want to thank Steptoe for sharing their expertise on this issue. Thanks along to our audience for your great questions. Please take a moment to fill out the exit survey so we can continue to bring you quality programming. And this concludes the webinar.